Hello there. Welcome to the Open here on BNN Bloomberg from a snowy Toronto. Let's get to the big stories we are bringing you from the BNN Bloomberg newsroom. The Chinese premier has reportedly told the Prime Minister, Mr. Carney, that China is interested in pushing forward to boost trade and cooperation. This report came after the Prime Minister landed in China looking for more talks. Mr. Carney and the Premier signed cooperation documents that centred on energy, construction and public security. Canada's housing market ended 2025 on a slide, with both housing prices and sales down, according to data from the Canadian Real Estate Association. The benchmark price dropped by almost 0.5% in December, marking a 4% decrease year over year. Analysts point to continued economic uncertainty as a reason for the continued weakness. And there's a look at oil dropping to prices we saw in October of last year. This comes after U.S. President Donald Trump said he will hold off on attacking Iran. Oil did push higher over the past one or two sessions amid geopolitical uncertainty, spurred partly by U.S. pressure on Venezuela. And there is a look at the U.S. futures. We did see selling in the U.S. market yesterday, but tech stocks have shown signs of life today because of strong results from Taiwan Semiconductor. The TSX closed at a new record high yesterday, boosted, of course, by another rally in precious metals. And let's have another look at oil, because oil had shown signs of life over the past few sessions, jumping above $60, but you can see it's down around 4% now on diminished prospects of a U.S. attack on Iran, at least according to the tenor of the president's remarks. And let's have a look at gold, which has been setting record after record, taking something of a breather this morning. And we'll check in on the Canadian dollar here. The loonie has been trading comfortably above 72 cents, but you can see US, but dropping below that level today. And finally, Bitcoin, the biggest crypto. Let's see how it's faring. And it is down, although above that $90,000 psychological mark, below which it has dipped over the past few weeks. We're getting yet more fourth quarter earnings from the big banks. Morgan Stanley beat expectations driven by strong revenue from wealth management, and Goldman Sachs posted record annual revenue. We did see pressure, though, on Goldman Sachs in the pre-market. Let's get reaction to these results from the huge U.S. lenders. We're joined by Martin Cobb, Senior Vice President of Equities at Lawrence Steinberg Wealth Management. Martin, always great to see you. Thanks very much indeed.
Great to see you too, Andy. Good morning.
It is a little tricky, I guess, gauging stock market reaction to the bank results, because we've got this threat by President Trump to cap interest rates, even if he's going to have severe difficulty pushing anything like that through.
Yes, I mean, what comes out of the mouth of the administration on a daily basis, it's hard to keep up with. And the capping of interest rates, we could really get into, almost the impossibility of doing that, and just how silly that would be in terms of just cutting off credit for the whole host of individuals. Obviously, today's banks, Goldman Sachs getting out of the consumer business, Morgan Stanley increasingly a wealth management business, less concerned for those individual businesses in terms of what happens with capping, say, credit card interest rates. But we came into, the set of results, hands up, anyone who thought they wouldn't have bumper results, they did. But we came into this year with valuations, a number of these stocks. We own all three, actually, of the investment banks in the US, but have been taking a little bit of money off the table because valuations are up there.
So they're expensive, these big US banks generally?
Yeah, I'm a former bank analyst. I won't bore you about the years I spent in banks' balance sheets. And I tend to look at price to book. It's a much better metric of valuing banks. They say price to earnings, just because the volatility that you have in earnings. I mean, Goldman Sachs in 2025 earned twice as much as it did in 2023, and who knows what it'll earn in 2026. So on price to book basis, the valuations are between 2.5, 3 times book value, for returns on equity in the kind of mid-teens. Now, that's higher than we've seen since any time since the global financial crisis. Indeed, for JP Morgan, higher than we've seen since the early 2000s. So a lot of good news baked into these share prices coming into this year. So no surprise from me that even with bumper results, good outlooks, that the shares prices have been a little bit soggy.
The TSX hitting record highs, fueled in part by gold stocks. I know it's hard to generalize about a market, but what interests you in Canadian stocks right now, Martin?
It's getting harder, Andrew, to find attractive stocks within in the Canadian market. We know how well the precious metal stocks have done, the gold stocks, the banks last year. Some of the retailers have done particularly well, like Aritzia and Dollarama. But there's always stuff under the surface, stuff that no one's talking about. I mentioned a couple of times, the railway stocks, I think, are great long-term purchases in these levels. And there's always something, a little bit of a, concern about it in the short term that ultimately may prove to be a very attractive entry point in the long term. But it's harder today because aggregate valuations, our banks too, are not exactly cheap. Aggregate valuations are up there.
Let's maybe have a look at a 5-year chart for CP and for Canadian National Rail. Obviously, those stocks were under pressure last spring because of fears over Trump's tariffs. And that's interesting. Actually, then they rallied, but then went on dropping. They have recovered a bit. You think investors may be missing value in the railway stocks?
I just don't think these businesses have changed all that much over, they've been around for 100 years. They'll be around for another 100 years. And if you look back, there's always some reason to be negative on their whales. And so today's tariffs, previously it was wildfires, then it was bad harvests, government interference. There's always something. But these are, your classic, high barriers to entry, extremely high barriers to entry, businesses. You cannot replicate them. As I say, they'll be around for decades. They'll continue to shift a bit more volume, every year that they do, through thick or thin, and they'll have a little bit of pricing power. The difference between now and, say, 5 years ago is they're trading on 2/3 of the valuation because they're just, people are concerned about tariffs, people are concerned about trade. Quite, I say not surprisingly, but, this too shall pass.
Yeah, I see CP Kansas City has had some bargaining pacts in the U.S. ratified. It's not huge. I think it's 700 railroaders, but it looks like one labor problem has gone off their, or a potential labor problem is off their radar there. You have some stock ideas for us. Automatic data processing. What do they do and why do you like them, Martin?
Yes, ADP, as we would typically call it, is largely a payroll processor, the world's leading payroll processor. 1 in 6 American workers will have their payroll processed by ADP. Wow. I have my payroll processed by ADP. It is just a phenomenal business. They handle between 2 and 3 trillion of clients' money every year. They sit on roughly 40 billion at any one time. There are competitive threats, but you don't want to mess with this baby if you are any company, processing your payroll. So the competitive barriers to this, I think, are very huge. They've grown their revenues every year this century. So even during the global financial crisis, unemployment rising, etc., they still grew their revenues on an organic basis. So huge barriers to entry, long-term secular growth, maybe have something like 10% market share. A lot of it's still done in-house. And ultimately, you're getting very dependable growth, expanding margins, maybe something like 10%, 12% earnings per share growth on a sustainable basis for the long term, trading on close to 20 times multiple. It's just one of those high quality industrials that today seems a little bit forgotten about.
That's interesting as well. Switching, who's going to want to switch that kind of data processor if you can avoid it? Yeah, you just imagine the bureaucratic hassles.
Their software, I'd say, is a bit clunky, but it doesn't matter. It's just they do what they do. It's a very low cost for a business to get them to process your payroll. They are embracing all the new regulations, etc. And it's just hard to get them out of your business once they're in.
Finally, Linde, a huge global player in industrial gases.
Yeah, this is again another high quality industrial that I believe looks very attractive today. We saw the news with TSMC. So if you're building a semiconductor plant, you need high quality gases. I mean, very high quality gases. They talk about the 5 nines, 99.999% purity, of a whole host of gases for semiconductor plants. The same with petrochemicals, hospitals. There's so many mission critical gases that these companies provide. What Linde does, and Air Products or others, Air Liquide as well, is they build the plant right next door to the semiconductor plant. It's basically on site with a 30-year contract typically, providing those gases, and then they can sell any excess into the merchant market. Again, huge barriers to entry. There's only 3 companies really in the world that do this, dominate the market, mission critical, very low cost in terms of the cost of the overall production of the client. But again, a bit like ADP, once they're in there, very hard to get rid of them.
Martin, always great hearing from you. Thank you very much indeed.
Thank you, Andrew.
Martin Cobb, Senior Vice President of Equities at Lawrence Steinberg Wealth Management. Coming up, we're going to look at a day in the life of a finfluencer on YouTube. That's coming up. With more than 1 million subscribers, this YouTuber is one of Canada's biggest finfluencers. That's a financial influencer. He unpacks current finance news, basics of investing, and sometimes even provides history lessons. We are joined by Richard Coffin, YouTuber at The Plain Bagel. It's great to see you. Thank you very much indeed.
Thank you for having me.
Just to get it out of the way, your day job is as a portfolio manager. You're with a shop called WDS Investment Management.
That's right, yeah, based out of Ottawa.
But you deal with client accounts and you wear many hats over there.
Yeah, it's started off as an investment analyst position and still do some support on the research side. Now it's more client facing and more of effectively a junior role where I'm supporting some of the other portfolio managers while also building a book of business. But predominantly it's, like you mentioned, it's the research and advising side of that side of business, yeah.
So tell us about your YouTube channel. What's your meat and potatoes? What's the main content you provide?
Sure. It's changed over time. Has started with a focus on basic investment information and slowly molded into more economics. And just with the last year we've had with the U.S. trade tariffs and everything of that sort, covering more news items, but really focuses on trying to cover basic information or break things down to a level where beginners can understand sometimes more advanced topics that still impact their financial situations.
Mm-hmm. And I mean, obviously Jim Cramer's been around for decades.
Sure.
He has his style.
Yeah.
It's kind of flamboyant.
Yeah.
And there are a lot of finfluencers out there who go down that road, but you're more subdued.
Well, I don't typically cover stock picks.
No.
A big part of it is really that focus on education rather than giving information and on which stocks to buy and things of that sort. A big part of that, too, is there's a lot of distrust with finance content that comes online. And I think a big part of building trust is focusing more on that high value education that helps people for their lifetime rather than picks that they might rely on in the short term. So there's a lot of reasons. Another part of it is the compliance side, working in the industry. It's tricky to be in the social media space and do so dotting your I's and crossing your T's properly. So it makes it a lot simpler to not go down that route. But frankly, it's just not what I enjoy doing online. I really enjoy covering the more education and broader topics.
Can you touch briefly on how you make money? You
Sure.
get paid by YouTube, I guess, a chunk of the advertising revenue?
Predominantly, yeah.
Okay.
Yeah, so it's predominantly YouTube AdSense is what it's called, and that's the ads that run during the videos. There's a small pie that's sponsorships, but because of the work I do in the industry, the biggest sponsorship deals are often ones I pass up because it's finance adjacent, and I don't typically cover that area. Again, from compliance nightmare generally, but also it's about that trust, and really I don't think I would be at this stage with the channel if I had gone down routes of promoting different aspects of the financial service industry. Mm-hmm. So it's really in terms of keeping the channel's integrity that I avoid those types of deals. Mm-hmm. So predominantly from AdSense, but when you look at other creators, there's courses and there's these sponsorship deals that are a bigger part of the pie than what I experience.
Right. And you have more than 1 million subscribers?
That's right. That's right. Yeah. One of the biggest channels in Canada.
How many of them actually watch regularly, though? Have you any handle on that?
Yeah, you do get some interesting stats behind the scenes. And interestingly, subscribers aren't a big driver of views anymore. It used to be a more important stat. These days, it's a lot more about how the algorithm treats your videos on a one-by-one basis rather than where you're coming from. Mm-hmm. And so you find that a lot of your viewership actually comes from new viewers or people who aren't subscribers. And you can have channels that aren't very big from a subscriber standpoint, but are having much more significant traffic than high subscriber count channels. So it's not as important of a statistic as it used to be. Mm-hmm. But even with that size, I've been fortunate where I've been able to get decent viewership numbers as well.
And I know we can't get into it, but this is the algorithm on YouTube.
That's right, yeah.
People search on YouTube.
That's right. So the algorithm is this ethereal entity that we all reference that we don't actually have much insight into outside of what we see from the outside.
Notoriously.
YouTube's very protective for IP purposes and things of that sort. But there are a lot of people who have dedicated time as creators to try and figure out what works on YouTube and the algorithm. It's also a tough thing with the finance space because sometimes what works for the algorithm isn't inherently good for viewers. So things like exaggerated titles or hyperbole and things of that sort, which can actually be detrimental to viewers, can do well on the algorithm. So it's a really tough balance to try and navigate that space without maybe doing some more harmful stuff.
Isn't that interesting? So I'm just plucking an example out of the air here. If I was to put a title on my video, the AI bubble is about to explode this week.
You do quite well, probably.
Yeah, but it's not necessarily something that's really going to be that helpful.
That's right. And, a big part of it is, and a nice thing about working while I do this is it does keep me grounded where I have to think to myself, there's a client that might be out there who watches my videos. And so if I post a video that says the AI bubble is going to collapse tomorrow or this stock is going to surge 1,000% tonight, I have to answer to that person at the end of the day when they give me a phone call and ask, hey, what was that thing you were talking about online today? So it does help in that regard, and it's been a good grounding force through all this.
You're about to turn 33.
That's right.
So tell us about the age group and the gender breakdown of your viewership.
Sure. On the gender side, it's predominantly male, which tends to be what we see in the industry. About 90% male viewership for the YouTube channel.
That's right. Interesting. Yeah.
And in terms of age demographics, tends to be that 20 to late 30s age group. So a lot of it is mirroring the demographics of the person you're watching. That does play a small role, I'm sure.
Late 20s to 30s.
Mid 20s to late 30s tends to be the age group. And so it is that younger, at times Gen Z investor group that tends to use social media more often. And we've seen that it's growing. We've had a lot of research to support that younger generations are predominantly using social media to inform their investment decisions these days compared to prior generations.
And you find that YouTube is the venue for you? Are you on TikTok or Instagram?
I've looked at other platforms. For me, I very much treat this as a hobby, or I try to treat it as a hobby, despite how big it's gotten. And so I'm not very strategic with the platforms I go on. I've heard that TikTok is an amazing discovery platform and then a great way to then transfer viewership from there to more monetizing friendly platforms. But, it's a tough, TikTok's a big one for finance, but it's difficult with the short form content with the type of topics I try to discuss. So I find that YouTube I like to focus on just the one platform. It tends to be the biggest platform for people looking for financial information, interestingly enough. So it's a good kind of mix where I can focus on this one core platform, which also tends to be the highest monetizing platform from an AdSense standpoint.
Oh, that's interesting. Richard, we could talk to you all day. Very interesting stuff. Thank you very much.
Thank you for having me.
Richard Coffin is a influencer on YouTube, and you can find him at The Plain Bagel. Just ahead, the Prime Minister is getting set to meet with Chinese leader Xi Jinping. We'll take a look at some of the issues in agriculture between the two countries. It's been called a historic moment. A Canadian Prime Minister back on Chinese soil for the first time in about a decade. Trade, energy, and agriculture are all on the table. What many Canadians, though, are looking for is movement on our agricultural exports, which some of which have been blocked by China with tariffs. CTV's Annie Bergeron-Oliver has more.
It wasn't long ago that Canada called China a disruptive power. Now the language has softened as Prime Minister Mark Carney's government looks to bring stability back to a frigid diplomatic relationship.
This is a new government with a new Prime Minister, a new foreign policy. In this moment of economic stress for our country, it is necessary for us to diversify our trading partners.
And Carney has made it clear that rethinking includes increasing non-U.S. exports through deeper partnerships with countries like China. And over the next few days, the Prime Minister will be pitching Canada to business and government leaders as a place to invest.
I think that this was a really important opportunity to reset the relationship at a time when we're obviously dealing with a much tougher United States and where our Canadian national interests have to be rethought.
A key area of debate and likely disagreement, Canadian tariffs on Chinese electric vehicles and Chinese tariffs on Canadian canola products. Government officials say it's reasonable to expect progress on so-called trade irritants, but the definitive removal of tariffs is unlikely.
Our ultimate goal is to restore market access to China, have more smoother, predictable trade with our number 2 export market. And so we're looking for signs of progress and resolution on that front.
This trip is all about getting business investment. So far, there are no cultural or heritage events on the schedule. Carney will spend his first full day in Beijing meeting with business leaders. Then he'll transition to China's Great Hall, where he'll meet with government leaders, including the Premier, and participate in 2 signing ceremonies related to energy and climate change.
Here's a look at U.S. futures as we count down to the opening bells. We did see pressure on U.S. stocks over the past couple of sessions, but it looks as though we are going to get a higher open when trading begins shortly. U.S. stocks set a record high close on Monday of this week, 6,977. And as you can see, it looks like we are going to eclipse that at the open. Looks like America's premier stock index is going to open in record territory above 7,000. And if it can hold on to that, it will be the first time in history that the S&P 500 has closed above 7,000. So we have, as I mentioned earlier, after decent results from Taiwan Semi, seen a rally in some tech stocks. It looks as though Taiwan Semi is just making all the chips that it can. There's no sign of a slowdown in demand for these devices to power AI computing. We are going to have those opening bells after this. Okay, there are the opening bells on Bay Street and Wall Street at the NYSE, at the NASDAQ. It's iMentor doing the honors. At the NYSE, it is Yorkville, America, ringing the opening bell. But I think Truth Social is involved there as well. I'm not 100% clear. And then at the TSX, it's Summit Royalties celebrating the listing on the TSX Venture Exchange. It's time for the first 15. Let's check in on the equity markets and let's see if the S&P 500 is trading in record territory above. Nope, not quite 7,000, but it is in record territory, but it's not above 7,000 because if it was, it would be on course for the first close above that level in history. In fact, the S&P 6,967. 6.9. So it's slightly down from Monday's record high close, but it is up amid strength in those tech stocks. And the TSX, no stopping it. It's like the Energizer Bunny, keeps climbing. That's, of course, is from a time when people bought batteries for their devices. It's in record territory, not far short of 33,000 for the first time. Couple of stocks that are on our radar. Cogeco Communications is out with its results. Desjardins is sticking with a hold on the name. The shares up around 1%. Desjardins says, we're waiting, though, for increased U.S. subscriber trends to translate into improving financials. The company has faced tough competition with its U.S. broadband business, and apparently there were encouraging U.S. subscriber trends, according to Desjardins, but management does not expect financial improvement until the second half of the year, and consolidated revenue was down about 5% in constant currency terms. And let's have a look now at First Majestic. You can see, down a little bit. This one has been riding the silver wave, though. Because, the AG, I always like that symbol. That is the periodic table symbol for silver. The headline I'm seeing is silver production misses, or the forecast for silver production this year missing estimates. So it looks like not delighting investors. But let me just check, because we saw gold slipping in early trading. That, of course, tends to cast a shadow over silver as well. So gold down in early trading, but still above the generic futures, still above $4,600. And finally, let's have a look at Cargojet. We have some commentary here from BMO. BMO remains a little skeptical on Cargojet, even though the stock has bounced off the bottom. There have been concerns about overcapacity in the freight market, and BMO is sticking with a hold on this name, saying we think that there's going to be volatility for the company's numbers for the next while, but the shares hanging in, and they have recovered from the lows of the fall. Let's get some movers south of the border. We're joined by Jeff Morgan, Deputy Team Leader at the Bloomberg News Equities team. Jeff, great to see you. There is some optimism among chip investors today.
That's right, and you're seeing it play out so far in the handful of stocks, but including Applied Materials. Applied Materials was the top-performing stock in the S&P 500 in the pre-market session. It's definitely worth watching as regular trading is getting underway here today. Two things worth noting with Applied Materials this morning. First of all, Barclays upgraded the stock to overweight from equal weight. Yeah, now we're seeing it up 8%. My goodness. But the bigger item that's kind of lifting this stock and lifting its peers this morning, Taiwan Semiconductor Manufacturing Co., TSM, came out this morning with, or just after close of trading in Taiwan, with guidance that is really lifting optimism kind of across the chip-making semiconductor space. And Applied Materials is getting a huge lift off of that. So Taiwan Semiconductor sees its revenues growing by almost 30% in U.S. dollar terms over the course of this year, which is kind of a reflection of the strong demand for chips and for I guess semiconductor and semiconductor components. So a number of the downstream and upstream companies that are kind of involved in that space, downstream and upstream of Taiwan Semiconductor, are getting just a great big lift this morning. Worth watching the entire space. It is, of course, also because of the size of it within the S&P 500, it is lifting the market. That sector is lifting the market almost on its own.
And Boston Scientific plans a big acquisition.
Yeah, from the top of the S&P to the bottom, this was the worst performing stock in the S&P in the pre-market session, and definitely worth watching today. They are going to buy a company called, and pardon me if I mispronounce it, Penumbra. This is a pretty expensive deal on a valuation metric based on where the stock was trading on Wednesday. This is a 19% premium on the closing share price for Penumbra on Wednesday, $374 per share, valuing that stock at $14 billion, or valuing the deal, pardon me, at $14 billion. So a pretty hefty deal for Boston Scientific to digest here. What this does is it gives them a little bit more exposure and kind of, I guess, broadens their reach within the cardiovascular treatment space. So yeah, big deal and big move lower so far this morning for Boston Scientific.
And we also, actually, let's loop back to the chips for a sec, if we could. We saw an upgrade for Broadcom and Lam and analog devices at Wells Fargo. That's
right. Wells Fargo upgrading all three of those and a handful of others. Yeah, and once again, we're kind of coming back to this Taiwan Semiconductor. So there's two things that are happening here. You do have this upgrade, and the upgrade from Wells Fargo was really kind of more broad-based than it didn't really touch on Taiwan Semiconductor as kind of the driving force. It just touched on the idea that there would be more demand. This is a space that is still expected to perform very well over the course of this year. And so it was kind of a thematic sector-wide upgrade on not just those names, but a handful of others. Then, I suppose, kind of reinforcing the thesis, you had Taiwan Semiconductor out overnight, maybe proving it right, at least in the near term, which is really helping all of those stocks move higher so far this morning.
Thanks very much, Jeff. Always great hearing from you. Jeff Morgan of Bloomberg. Coming up, Goldman Sachs and Morgan Stanley both beating expectations this morning. That's ahead. Morgan Stanley and Goldman Sachs shares did come under some pressure in the pre-market, even though they beat expectations on earnings. Let's have a look at those stocks right now. And let's get more from Colin Shazinski, Portfolio Manager and Chief Market Strategist at SIA Wealth. Colin, great to see you, and thanks very much. Start off with Goldman Sachs. Apparently, they set a revenue record.
Absolutely. Goldman Sachs put up really strong numbers. They also crushed on estimates. And I'll just note quickly, we do own both Goldman Sachs and Morgan Stanley in portfolios that we manage. So it's a very good day, and we're quite pleased with the numbers that have come out. And so Goldman Sachs, they also had sold off their credit card business along the way with a gain on that. But generally speaking, they were very pleased with their results, and they saw results coming from wealth management and coming from trading and asset management. So across the board, a very strong quarter for Goldman.
Yeah, we did hear Martin Cobb, the stock up around 2% right now. We did hear Martin Cobb of Lawrence Steinberg Wealth Management earlier, who, let's forgive him his sins, he used to be a bank analyst, he's saying that these big US lenders are generally trading at fat multiples of their book value. Would you be putting new money into them right now, Colin?
At this point in time, they're continuing to do really well, and all indications are that we're in a very robust environment for the banking business, for the brokerage business, for wealth managers. We've this week we saw positive retail sales. This morning's numbers out of the States, the two manufacturing surveys, New York and Pennsylvania, very, very much stronger than expected. The U.S. banks that had reported earlier in the week generally had smaller than expected loan loss provisions. So at this point in time, the banks have been doing well and continue to do well.
Tell us, Taiwan Semi, apparently like other players in the chip market, including the memory device providers, it's just turning away orders practically. They just can't make enough chips.
They had very, very strong numbers reported overnight. And that's quite impressive because it helped to turn around sentiment towards the whole sector. Yesterday, we had technology stocks in the NASDAQ getting absolutely hammered. And we've seen a lot of weakness for several weeks of questions over, can this AI-related growth continue? Well, now Taiwan Semiconductor's numbers came out overnight and said, yes, they can. They blew the doors off their numbers, and this not only turned their stock around, it turned around the entire global chip sector. We saw rallies in Europe, and we're seeing rallies in North America this morning. So quite a change of sentiment off of just one number.
What do you think, Colin? Are there going to be tears in the end with these AI stocks, especially if somebody like OpenAI, which has so much debt and such aggressive spending plans, runs into trouble?
Eventually, we saw that 25 years ago with the internet, where when it first came out and there was huge potential and all kinds of stocks ran, and then at some point there was a shakeout. We don't know when this is going to happen, but anytime there's a new technology, eventually there's a shakeout and you get winners and losers. And there were losers who failed spectacularly, but there were winners who succeeded spectacularly. So there are opportunities. There are also risks in the market.
Are there any risks other than a possible tech sell-off any broad risks in the market or economy that you think investors are underestimating right now, Colin?
There's a few things. I mean, one is just general, I call it political sentiment, and we're seeing it this week right now in the oil market, and this week it's Iran in focus, and a couple of weeks ago it was Venezuela, and we've had Cuba and other countries kind of go in and out of Greenland, to go in and out of the political risk space, and so. We've seen overnight, the last 2 days, people were starting to worry about could the U.S. attack Iran? Well, the oil price went up, and then overnight, President Trump kind of said, well, maybe they won't, and we see the oil price come right back down again. So that can impact energy. That can also impact metal stocks as well. The precious metals, of course, tend to go back and forth quite significantly on greed versus fears. So it is those are certainly ongoing. I don't want to call it like a major risk, but certainly ongoing significant volatility in those spaces. The volatility goes both ways. They could go up, they could go down. So that's significantly, and that can change day to day, and as we've seen sometimes even within a trading day. So it's that's one to always be definitely be keeping an eye on.
Do you feel we're in a strange era now, Colin, with so many opportunities to gamble on sports, whether legally or illegally, and then the likes of Polymarket and Kalshi blurring the line between investing and gambling? I know investing to some extent has always had, a gambling aspect to it, but we really seem to have those two worlds moving together right now.
It's an interesting one because a lot is going online, and so, for example, we've heard rumblings over the last 2 months that the traditional casinos are having trouble. We've seen rumblings over the last few months of Las Vegas traffic being way down, and just recently Halifax indicated they're closing their casino downtown and moving it over to Dartmouth. So there's definitely changes in the sector, and yes, there is a blurring, and we're kind of now getting more like Europe, where you can bet on just about anything, and it's intriguing at the same time when you think of things like the poly market and things like that as well, because they also give intelligence, because there's a big difference between a poll where people can get on the phone and say whatever, and a betting market where people are stating their opinions with their money.
Yes.
And so it's quite different. We've seen that develop over the years in the election markets, and that's now spreading out into other areas. Yeah,
it reminds me of P.G. Woodhouse and those dim-witted English aristocrats in his stories. They always were able to calculate complicated odds on horse racing. In every other respect, they were pretty dim. Colin, thank you very much indeed. Colin Szysinski, Portfolio Manager and Chief Market Strategist at SIA Wealth. Yesterday on Market Call, we were joined by Bruce Campbell of Stonecastle Investment Management, and his top ideas were Energia, the renewable natural gas player, Kits Eye Care, and Tenaz Energy. And today on the show, it's Andrei Omelchuk. He is CEO and Chief Investment Officer at Lineguard Capital Management, and he'll take your questions on North American small and mid caps. Just ahead, the cost of an average home in Canada fell 2% last year. We'll have more on this pretty moribund housing market when we return. The average national price of a home sold in Canada in November was just over $682,000, and that was down 2% year over year. Let's get more from CTV's Camille Karamali. Thanks very much for joining us. What are the key takeaways from the latest housing market data?
Yeah, the key takeaways are that there will be more homes that exchange hands in 2026, as well as the average price of a home or a property is going to go up. That is according to the Canadian Real Estate Association's forecast for 2026 and for 2027 released this morning. And what it essentially says is that there's a lot of pent-up demand from first-time home buyers, especially especially, who've been waiting to enter the market. But the increase in the interest rates as well as the housing prices have really shut them out of the housing market in the past 4 years. So this is their gate into the housing market, and the floodgates are expected to open in 2026. So let's take a look at some of the numbers that we have here. So right now it's saying this report that roughly what we've seen here is that roughly last year we saw about 470,000 homes exchange hands. That's set to go up over 500,000 to 511,000. So an increase of 5% of properties will be bought and sold in 2026. And the average price of a home across the country was $679,000. That is expected to go up 2.8%, up to $698,000. So almost $700,000 is the average, is going to be the new average price of a home, according to this real estate forecast. Probably no surprise here that the most expensive pieces of property on average are going to be in BC and Ontario in 2026, with BC being $975,000 on average for a home in British Columbia. That is up 2.3% from 2025. And in Quebec, or rather in Ontario, $842,000 is going to be the new average estimated price for a home in 2026. That is up just under 1%, 0.8% increase over 2025, but still an increase and a pretty expensive price to pay for a piece of property. Once again, two of the more expensive provinces where you will have to pay quite a bit to buy a home. And then once again, these Canadian Real Estate Association forecasts also give you a little bit of a snapshot into 2027. And because there's been so much pent-up demand, especially once again from these first-time home buyers who have been waiting 4 or 5 years to enter the market, they're also expecting 2027 to have an increase in the number of homes exchanging hands, as well as the number, the increase in price as well in 2027. So only upwards from here when it comes to the number of homes bought and sold and the prices as well.
Camille, thank you very much indeed.
Anytime.
Camille Karamali, our colleague at CTV News. Up next, we are going to look at some of the crucial items on the Prime Minister's agenda as he negotiates or talks to the Chinese regime. We'll be right back. Prime Minister in Beijing, first trip by a Canadian Prime Minister to China in almost a decade. What are the next items on Mr. Carney's agenda and what's on his itinerary? Let's get more from CTV's Jeremy Sharon. Jeremy.
Hey, Andy. Yeah, look, this is an important trip for the Prime Minister. And as you've touched on, the first official trip by a Prime Minister to China since 2017. The Prime Minister today spent his first day of official business meeting with a number of government officials, including Premier Li Qiang. And what we've seen as a result of what has happened today is a slew of agreements being reached between the two countries. We've continued to hear this Prime Minister and his government talk about bolstering relationships and increasing trade relationships with other partners in an effort to diversify. And we have heard that will include a bolstered trade relationship with China, a massive Asian economy. What we've seen today is memorandums of understanding signed on energy cooperation, forestry, combating crime, on culture, food safety, as well as a letter of intent for cooperation between Destination Canada and the China Media Group. So, a number of agreements signed between the two countries, along with an economic trade cooperation roadmap that was announced by the two sides, where the Prime Minister was pretty clear that Canada is looking to open itself to more investment in a number of sectors by the Chinese government. So this is, if you will, Andy, the laying of some groundwork for what we could see this relationship between Canada and China build to in the future. We're seeing a number of sectors being identified as areas where both Canada and China are ready to cooperate. And I think most notably, energy is somewhere we're seeing a big focus from both sides on potential cooperation and potential partnership in the future.
So they're calling this a stepping stone to reset relations because there's a lot on the line here. Of course, the Prime Minister is under pressure from Western farmers to get rid of these Chinese tariffs on canola, for example.
Absolutely. This is, as you've touched on, it's been referred to as a stepping stone. And that's why I'm kind of saying this is the laying of the groundwork, if you will. There is still a lot of work to be done. And to your point, there are still many questions about what can be and whether more will be accomplished during this trip. The Prime Minister will meet with President Xi Jinping tomorrow. It will be another significant day, of course. And the question is whether or not we'll see any kind of change on tariffs, the 100% 100% tariffs imposed on Chinese EVs, and the significant tariffs on a number of canola products that are hitting canola farmers here from the prairies significantly. And so the Prime Minister is facing pressure on both sides because he is facing pressure to alleviate the pressure on canola farmers, while here in Ontario, Premier Doug Ford has made it clear he does not want to see this government reduce its tariffs on Chinese EVs because that would hurt Ontario's auto sector. So there's a lot of work still to be done. And while doing all of this, the Prime Minister and his team are faced with balancing, bettering a relationship with China while also engaging in trade negotiations with the U.S. If they do too much with China, it could be seen as a negative thing by the U.S. administration. And so there are certainly a lot of moving parts here, Andy. Everyone is watching very closely as to what happens next and how that meeting tomorrow goes with President Xi Jinping, of course.
Thanks very much, Jeremy. Really appreciate it. Jeremy Sharon, our colleague at CTV News. Coming up, we'll check out the markets, including Constellation Software hitting a new multi-year low. We'll be right back. Welcome to the second hour of our show. Let's check out the big stories we're bringing you from the BNN Bloomberg newsroom. Home sales across the country ended 2025 on a decline as the trade uncertainty fueled concerns over the economy. Data from the Canadian Real Estate Association indicates that the number of homes changing hands fell 4.5% in December versus the previous month. And the industry group says new listings were also down 2%, marking the fourth straight monthly drop. Shares in Bombardier trading higher. The plane maker is expanding its manufacturing operations in Quebec with a $100 million project. Bombardier says the investment will see it opening a manufacturing center in Dorval that's set to be completed by 2027. The new center is aimed at supporting existing facilities as well as increasing production capacity. The Chinese Premier Li Qiang has reportedly told Prime Minister Mark Carney that China is interested in pushing forward with a boost in trade and cooperation. This report came after Mr. Carney landed in China looking for further discussions. Carney and the Premier signed cooperation documents which centered on energy, construction, and public security. And there's a look at the TSX. It is trading in record highs territory today. Let's have a look, though, at Constellation Software. For years, it was a favorite blue chip among Canadian investors, but that one dropping below $3,000 today to hit a new multi-year low. And among other things, there are concerns that the advent of AI will hollow out the business of old blind software companies like Constellation. And let's check out the U.S. markets because the S&P 500 is still slightly shy of that 7,000 level it hit in the pre-market. However, it is close to the record high set on Monday. Morgan Stanley and Goldman Sachs beating expectations. And Taiwan Semiconductor also topped fourth quarter targets and increased its forecast. Let's get more from Laura Lau, Chief Investment Officer at Brompton Group. Laura, great to see you. Thanks for joining us. Anything of interest there with the Morgan Stanley and Goldman Sachs numbers? Anything jump out for you?
I would say that trading revenues has been very, very good. Goldman Sachs beat their previous equity trading numbers. The pipeline for investment banking is very strong. Morgan Stanley, their asset management arm, is getting close to that magical $10 trillion of assets under management. So on the whole, just very, very good. And looking forward, the pipelines are very, very strong. We're expecting we could get some big IPOs this year. We could get, OpenAI, which was, the makers of ChatGPT, Anthropic, the makers of Claude chatbot, and then SpaceX. So we expect the earnings for the investment banks to continue to do very well.
It's interesting, isn't it? Yeah, I mean, this is going to be, if these huge IPOs come off, they could be record breakers, certainly in the industry that they operate in.
And they're helping to fund AI. So certainly Morgan Stanley helped fund Meta's big debt offering. So that, goes kind of into TSMC, Taiwan Semiconductor. That's how they get the money to build more plants and increase their capital program and increase their revenue.
What about Taiwan Semi? Maybe we can have a look at that stock. Like other chip makers, it seems it just can't meet demand.
So demand has been just so strong, and it takes a long time, a lot of expertise to build these big plants. So they're estimating this year alone, $56 billion. That's a lot of money, and they expect the next 3 years to be even higher in terms of capital. And they also expect the revenue to grow 30% this year. That was much higher than people expected. Analysts expected only 25%.
You have some stock ideas for us. An interesting one, Cardinal Health, huge player in the U.S. medical system. What attracts you there, Laura?
So what we've seen is the past couple of years, healthcare has actually underperformed. However, we do think that since it's underperformed, that some of the funds flow will be going back to healthcare, especially since we're seeing some of those policy headwinds dissipate. So we had basically a lot of the drug companies had issues with Trump. Trump wanted lower prices, and they've negotiated a lot of those. We think some of those headwinds are done. And what we do like about Cardinal is that their play on drugs. And we do see that with the aging demographic that more and more Americans will be using more drugs. So they are a play on that. The other thing they're a big play on is as they age, a lot of those specialty drugs where you need infusions, like for cancer treatments, that's growing. And what they also benefit from is a lot of drugs are going off patent. And when these drugs are on patent, their profit margins are 1%. When they go off patent, the profit margins jump to 15%. And the next 5 years, we see a big jump in those drugs that are going off patent opposed to the previous 5 years. And the valuation is less than the S&P 500, yet they're growing 10% per year.
Laura, last night I started some bridge lessons, beginner bridge lessons, tried to keep my brain cells functioning, but society is getting older, there's no doubt, the demographic profile. Chartwell Retirement Residences, you see opportunities there?
So the opportunity we see is, again, the aging demographic. So those, especially 80 plus, that tend to go into these senior housing homes, that is growing. That population is growing by 4% over the next 20 years. However, in terms of the housing, it's growing less than 1% in Canada. So we need at least 20,000 units per year to keep up with the demand. Last 3 years, we built maybe 9,000 a year, and we're seeing the starts are 7,000. So we see a big gap in supply and demand, and as a result, they are getting pricing power. So this is, we think, of a good long-term theme.
And then finally, discount retailing, TJX. Their off-price brands or chains include Winners in Canada.
Yeah, so Winners, TJ Maxx, they have that treasure hunt where you never know what you're going to get. And they're definitely in that, they appeal to those discounters, lower price and value. We're seeing that whether Americans or Canadians, we're really treasuring value. And that's what TJX offers. So it's been a long-term compounder, much like Costco. And we think that they will continue to do well.
Yeah, it is interesting. And it's the thrill of the hunt, too. It's partly recreational. You never know what you're going to find. Yeah. Laura, thank you very much indeed. Laura Lau, Chief Investment Officer at Brompton Group. Coming up, we're going to check out some of today's notable analyst upgrades, downgrades, and price target changes. Let's check out a few notable analyst calls. Agnico Eagle is first on the list, and we're talking about the U.S. Listed stock here. Of course, it trades in Toronto as well. Citi is raising its price target on the gold miner to $256 US from $198 and sticking with a buy rating on the shares. Citi cites the outlook for Agnico and a higher commodity price forecast for that target bump. Naturally, Agnico, like other gold miners, gaining from these record high bullion prices. And we're also looking at the US listing of a Canadian stock here. It's Magna International. Goldman Sachs raising its price target on Magna to $68 US from $60. However, sticking with a sell rating on the shares in the price target raise, the firm cites recent auto sales data points and comments surrounding 2026 growth. The analyst still, though, pessimistic broadly on Magna, seeing better value in other auto-related stocks. Coming up, we are zeroing in on the ETF market. Stick with us. Let's check out a few Canadian stocks of interest here, starting off with Nutrien. Nutrien hitting its highest in at least a year. It got an upgrade this week from Morgan Stanley, citing strength that the analyst sees in the potash market, crucial product for Nutrien. We're also seeing strength in Sprott. Sprott, of course, has a bunch of funds, many of which focus on resources, uranium and gold. They have exchange-traded funds in that area, for example. That stock on fire, up another 1% today. Another company doing well, Wheaton Precious Metals in record territory. Down a little bit today, but actually hitting a new record high today. We're also seeing investors buying into BRP. We told you yesterday that Citi sees promise here. The prospect of rising sales. DOO is the ticker symbol there, of course, because they make those CDOs. That stock hitting its highest, BRP, in at least a year as well today. Thanks, Control Room. And still down actually from just over 2 years ago, but rising rapidly. Here's the stock that's on fire, NextGen Energy. They are planning to build a gigantic uranium mine in Saskatchewan. They just announced an expansion of the high-grade ore at their Patterson Corridor East. They just got their price target raised this week to $17 from $14 at Raymond James, with that uranium stock on fire right now. Let's have a look at Docebo here, because Constellation Software suffering, and Docebo, which helps train customers. If you have a website and you have customers working through it, These things can be so complex that the customers need to be trained. DCBO is the symbol for Docebo. Thanks, Control Room. Investors not interested in that one right now. Okay, let's get to the ETF report. We're joined now by a longtime observer of the ETF market, Mike Philbrick, CEO of Resolve Asset Management. Mike, it's great to see you. We have been hearing this week about the enormous inflows into the ETF market in both the US and Canada. The Wall Street Journal has a headline today: ETFs are eating the world. They're so popular, eclipsing mutual funds. Certainly in terms of growth. In fact, money has been coming out of mutual funds. What has interested you about these flows, though?
Well, it's been interesting. 2025 was certainly the year of momentum meeting Main Street for the ETF world. Low fees, endless choices, 125 billion in inflows, 1.2 trillion in trading in Canada. It's been a blockbuster year, and I think this year has also been a year of innovation and rotation.
Right. What in particular have we seen in terms of rotation?
What was interesting, right? So if we take a trip in the time capsule back to April of 2025, we saw the tariff tantrums really kind of cause a lot of market consternation. And during that period, rather than seeing a rotation from stocks into, let's say, safe assets like bonds, what we saw was rather a rotation from, the U.S. market dominance to international stocks. The Canadian market, for example, outpaced the U.S. market. We saw moves into precious metals. We saw continued development in the digital asset space. So we saw that broadening of the market rally from technology and broadening out into things that are going to be needed to provide that growth in the AI space.
We've seen so many innovations, though, here. Option income, leverage inverse, crypto asset. But we've also seen what you say is strong demand for simple asset allocation ETFs as a one-ticket solution. Is that, for example, ETFs that would invest in both stocks and bonds?
It's actually across the board. Yeah, we saw that one factor was pretty interesting in 2025, that investors were looking for sort of that single ticket option and in more of the core drawer rather than the explore drawer. A lot of stuff was fun and flashy, that you talked about some of the levered covered writing ETFs. Mm-hmm. But this fell in the category of, hey, just give me one ticket. Diversification across whether it was asset classes, stocks, bonds, maybe some gold, maybe some Bitcoin, also across factors. One of the ETFs I'm bringing everyone's attention to today is the FEQT, which is the Fidelity Global ETF, which this one is really interesting because it's across these areas like Canadian stocks, sure, you have that. And then you have the sort of momentum, value, and quality plays within that, as well as international, in that U.S. play and international plays as well. And also with about a 3% allocation to Bitcoin. So here you have a wonderful equity replacement. You've got all the factors covered. You've got the geographical regions covered. You've got a small slice of digital in there. And so you can kind of forget it, set it and forget it. And that's been attractive for clients. And that's nice to see because that's a really great product for the long term for investors.
That's interesting. One ticket global equity fund from Fidelity. Another one has caught your eye, and this is PFAA, the Picton Mahoney Fortified Alternative Fund in Canada. What does this one hold?
Well, this one is a liquid alternatives multi-strat or multi-strategy fund. So it's got things like merger arb in it. It's got long short equity portfolios in it. And so it's got a portfolio of about 5 to 6 different alternative strategies. And these alternative strategies they move differently than the market. So what this can do is it adds some stability to the portfolio. So if you're someone that's looking at 2026 and saying, geez, my bonds aren't what they used to be, and I am worried about a little bit of equity risk, this is something that can add some durability to the portfolio and doesn't necessarily require equity beta or an equity bull market to actually provide some returns. That also provides the benefit of a nice place to rebalance to and from. So when your equities run up a lot, you rebalance back to a weight, adding to a fund like Picton Mahoney. If equities pull back, then you actually have a place to harvest some capital from to buy those equities in a dip when you've got a fund like the Picton Mahoney fund in your portfolio.
The Wall Street Journal is a little skeptical, though, about some of these more exotic funds. It says that some of them have unbelievable yields. It says that one that sells covered calls on Tesla touts, and I'm just quoting from the Journal here, a 46% distribution rate, in quotes. However, since 2022, investors have just made 62% in total. So some of these structures don't work out that well.
Correct. And, I'm going to call it yield porn. To some degree, investors can get mesmerized by those lead yield numbers. Mm-hmm. And you always have to look at what's the total return for the year. If the yield was supposed to be 42% and the total return of the underlying product was 12%, your return was 12%. And the yield is a distraction, and it's probably not helping you from a portfolio perspective. We also saw some paying weekly instead of quarterly. And so some of that can be distracting and can be deleterious to investor outcomes. So you have to be very careful. There's a lot to unpack in that. We don't have time today, but one of the rules of thumb is if you've got a 42% yield, but it's only earned 16%, you receive 30% of your capital back.
Sorry, give us that last number again, Mike, please.
Well, if the yield was 42%, let's say, and you made 12% on the year, really you received 30% of your own capital back. It wasn't that you actually made those money. So you want to look at that yield with respect to the total return of the ETF, the underlying ETF, to give you a sense. That's just one quick and dirty way to take a look at it and see if you're actually receiving the yield or you're just receiving your own capital back.
Right. And it is interesting. ETFs exceeding, obviously, by quite a margin, the number of listed stocks now, is certainly in the US market, and I'm sure in Canada as well.
Yeah, absolutely. And that's actually not new. I mean, back in the 90s, when there was a proliferation of mutual funds, the same thing occurred. The number of mutual funds outnumbered the number of stocks. And that's, fundamentally going to be true if you've got a constituent to 2,000 equities and you're going to build products off of that. You could build infinite number of products. From that, value tilt to quality tilt to covered right, levered. The proliferation of choice is huge, and investors have to be careful because some of that is a distraction. And what's your daily driver? What's going to do most of the work versus what's a shiny bauble in the portfolio? And that's that core and explore approach. Just make sure you're sticking with more core, lower fee stuff and adding the higher priced things around the periphery.
Mike, what do you think would be the next big thing in ETFs, though? Because they are, there's no doubt, cannibalizing the mutual fund industry or eating it up.
Yeah, I mean, it's hard to dispute the investors' yearning for yield. So I think, the yield plays are still going to have a particular role and attraction for clients. Some things that we're seeing on the portable alpha side, return stacking is something that we do. But this is taking the beta that love and trust, stock, bonds, and so on, and adding the diversifier on top. And so that's been popular, and we've seen that across the board growing nicely. So I think we'll still see more of the income side. I think those products are going to get better, too. I think that investors are wising up. And so are providers. So you're seeing better options for those covered writing strategies, for those levered strategies to give clients better outcomes. So I think we will see improvements in the products we have. As for what's new, I think that portable alpha play is interesting. And I think we're going to see more of those one-ticket items, one-stop ticket items where it's a fully baked product you can own.
Mike, thank you very much indeed. Mike.
Always a pleasure, Andy.
Mike Philbrick, CEO of Resolve Asset Management. Coming up, the US president doubling down on his push to acquire Greenland. And some European countries have been putting symbolic numbers of soldiers into Greenland just as a gesture. We'll hear more after this. Shares in Alamos Gold under pressure. Of course, those shares have more than doubled in the past year. The miner posted gold production in its latest quarter that came in below expectations. And full-year output also missed the mark. Alamos says the results were affected by severe winter weather, seismic events, and mine work. And the company's forecast for gold production also fell short due to lower than planned output from Canadian operations. Shares in Cogico. Oh, we've got Cameco there. I think it should be CCA is what we're looking for. Thanks, guys. Cameco doing just fine, the uranium giant. Shares in Cogico Communications rallying today, up around 3%. The cable and broadband company reported a higher profit in its most recent quarter that came in above estimates. Cogico says despite a challenging radio market, it's also a broadcaster, revenue increased versus the year before, driven by robust growth in digital advertising. And the company reaffirmed its 2026 outlook. Shares in Bombardier trending higher, up about 3%. That company expanding a manufacturing operation in Quebec with a $100 million project. Bombardier says the investment will see it open a manufacturing center in Dorval that's set to be completed by 2027. And you can see the TSX moving further into record territory, topping 33,000. So the TSX, if it can keep this course, will close today above 33K for the first time in the history. The S&P 500 is higher, still though I believe marginally down from Monday's record high close. Yeah, but it's only about 9 or 10 points short of that mark. The White House under US President Donald Trump is doubling down on its push to acquire Greenland. Several prominent US Republicans are among the lawmakers denouncing the move. ABC's Rachel Scott has more.
This morning, President Trump renewing his call for the U.S. to acquire Greenland.
We need Greenland for national security, so we're going to see what happens.
Top officials from Denmark and Greenland traveling to Washington, meeting with the Vice President and Secretary of State. But the high-stakes meeting appeared to make little progress. A Danish official declaring that a fundamental disagreement still remains.
We didn't manage to change the American position. It's clear that the president has this wish of conquering over Greenland. We made it very, very clear that this is not in the interest of the kingdom.
Hours before that meeting, President Trump insisting NATO would be stronger with Greenland in the hands of the United States. Adding anything less than that is unacceptable. For weeks, the president has been ramping up his rhetoric, saying one way or another, we're going to have Greenland, and has not ruled out using military force to get it.
I would like to make a deal, the easy way, but if we don't do it the easy way, we're going to do it the hard way.
Denmark, a NATO ally, has made it clear they're happy to work with the United States to bolster security in the region.
But that doesn't mean that we want to be owned by the United States.
The country now taking preventative measures to deter the U.S. from acting, expanding its military presence on the island and asking other NATO allies to help. Overnight, a Danish plane arriving on the island for a military exercise. Here at home, there is little to no support for using America's military to take Greenland. A new poll shows 86%, including nearly 70% of Republicans, oppose doing so. Republican Senator Mitch McConnell warning that if the U.S. goes after a NATO ally, it will be incinerating the hard-won trust of loyal allies. Other lawmakers agreeing.
Military action against Greenland would be the most serious national geopolitical mistake this country could make and would weaken us.
Rachel Scott, ABC News, Washington.
So Associated Press says several European countries, including France, Germany, Britain, Norway, Sweden, and the Dutch, have started sending symbolic numbers of troops to Greenland or have promised to do so shortly. Right, we're going to get some hot picks in transportation after this, including Union Pacific. We'll be right back. Oh, I presume this is a serious story. Bloomberg says that according to a Jefferies analysis, the growing use of weight loss drugs in the U.S. may end up saving the biggest U.S. carriers as much as $580 million U.S. in fuel expenses this year. Now, I'm just looking at some of the numbers here. So if there was a 10% weight loss by the passengers, that would save as much as 1.5% in fuel costs. They're huge users of fuel. They're expected to spend almost $39 billion US, just the top 4 carriers in the US, including United and Delta. So $39 billion US they're expected to spend on jet fuel this year. And slimmer flyers could bring down one of those big expenses. Some of this stuff, I'm finding it a little bit hard to believe. Apparently, the airlines have been desperately trying to reduce the weight of the aircraft. They've taken an olive out of a salad. Oh, come on. They've removed in-flight magazines. That's interesting. Yeah, you don't see those anymore. And they pivoted to super slimline seats. But apparently, these increased popularity of drugs such as Ozempic and Wegovy are actually, they do mean money for the airlines, although the analyst said our savings estimates don't include any lost snack sales. It's really incredible, though, the far-reaching effects of these weight loss drugs, although some research suggesting that when people go off them, you do tend to put on the weight again very quickly. And some people do quit because of expense, although that's going to come down with the generics, and because of side effects. But we don't know. I mean, we don't have multi-year or decade-long patterns on these weight loss drugs. And of course, the pharma industry would love to have a medication that people just stay on forever. Anyway. So there you have it. Let's have a quick look at the TSX and see if it's in record territory. We're having trouble bringing you those hot picks in transport right now, but we are working on it. TSX trading in record territory, poised to its first close above 33,000. Our market moving up. Let me just check, as ever, for what stocks are attracting a whole bunch of trading volume in dollar terms. Toronto Dominion Bank is higher, up almost $1. We are seeing some weakness in Canadian natural resources. It's down around 2%. We did see weakness in oil prices after U.S. President Donald Trump toned down his rhetoric on Iran, reducing the perception that he might plan attacks on that country. Shopify was sold off yesterday, up around 2% today. I mentioned Constellation Software hitting another multi-year low and sliding below the $3,000 level. It's down about 3% right now. Bombardier jumping about 3%. So a bunch of these big gold miners are up again. Agnico Eagle up around 1% last time I looked, and Kinross up around 5%. Agnico Eagle, it's a darling, of course, among investors because of its mines in relatively safe jurisdictions. Wow, Agnico Eagle just this year has jumped around 19% just in calendar 2026 so far. On Hot Picks today, we are looking at transportation, and our guest has Union Pacific as his top ideas. He says synergies from a potential merger with Norfolk Southern could provide significant upside for investors. We're joined now by Ari Rosa, analyst at Citi. Ari, thanks very much indeed.
Yes, indeed. Thank you for having me.
Just update us, what is the latest on that potential merger between Union Pacific and Norfolk Southern?
So there's still a lot that's unknown. Union Pacific and Norfolk Southern, they submitted a merger application to the Surface Transportation Board, the STB. They did that in late December. And so now the STB is in the process of reviewing that. There's a 30-day comment period. And so we're expecting that by January 18th, they should have comments back. And so that'll be interesting to see what kind of feedback they provide. Of course, a lot of the competing railroads have raised all sorts of complaints and concerns, saying there's insufficient disclosures, that it doesn't discuss enough how it could impact competition, that they haven't provided enough detail around their synergy targets and what kind of business growth they expect to achieve. But look, I mean, it's a 7,000-page application, so it's not exactly lacking in lacking in information. It's just a question of are they providing the right information, and will the STB find that credible? And that's a question that, frankly, is going to play out over the course of the year. And so as we think about, we just issued last week, we issued our 2026 outlook. One of our predictions, it's not really going out too much on a limb, but this discussion around Union Pacific and Norfolk Southern really will dominate headlines across our space, at least across the transportation landscape throughout the year.
But even if the merger is delayed or it doesn't even happen, you think Union Pacific looks like a decent stock right now?
Well, absolutely. So this is the reason really we like Union Pacific so much right now, is that it's kind of fallen into what we're calling deal purgatory, where the stock really hasn't done very much. You can see from that chart there. And yet the network is running phenomenally well. I mean, some people would say it's running the best that they've ever run in terms of network fluidity, efficiency metrics. And so they're doing a really nice job in terms of free cash flow generation. Their margins look solid. And so this is a business that, almost regardless of what the merger outcome ends up being, I think they're quite well positioned. And so relatively little downside and fairly attractive upside, which is kind of a setup that we tend to like. And then, of course, you have that extra kicker if you get the merger synergies that the company's been talking about. Now, in fairness, some of those won't materialize until 2028, 2029. But either way, Union Pacific looks like a stock that has relatively little downside risk and is just a very high quality business that continues to produce a lot of free cash flow.
Yeah, we're tight for time, and I'm sorry about that. United Parcel Service, UPS, despite competition that has pushed the PE multiple down, you see potential here.
Yeah, and so UPS pushes us a little further out on the risk spectrum, but UPS has a 6% dividend. So any of your retirees there, any of your long-term holders, I think they should be drawn to that. And frankly, look, we see the 6% dividend yield as too high. It should come down over time, and that, of course, should support the stock price. UPS was pretty explicit in coming out last quarter and saying, look, the dividend is safe. Our analysis suggests the balance sheet continues to be strong. And so it's a really nice dividend yield. It has some challenges. They're facing some questions around competition, but kind of at a fundamental basis, from a fundamental value basis, I think UPS looks attractive.
And then finally, a Canadian name. We're going to look at the New York listing, though, for a TFI International, a big trucking company.
Yeah, we really like the management at TFI. We have Mr. Alain Bedard, who's been a colorful character in the industry for years. But he's a really sharp operator and a really savvy business mind, where he focuses on the things that management teams, we wish more management teams would focus on those things, which is how do you drive shareholder returns? And so very focused on free cash flow, very focused on being opportunistic in terms of M&A opportunities. When everyone is down on the cycle, that's usually when he's most active. And so we think there's a lot of upside there. And particularly given some of the things that have been happening on the U.S. side, where trucking rates have started to pick up because of some of the government enforcement actions, we think TFI is well positioned to benefit from that because, of course, they have quite a lot of business both in the U.S. and in Canada.
That's interesting, yeah. And you say, I think you may have touched on this, but you say a good record of acquisitions.
Absolutely, yes. And so they've been very acquisitive, and that in turn has driven up earnings per share over time. They're very savvy about M&A and doing it opportunistically to drive kind of accretive earnings growth.
Thank you very much, Ari. Really appreciate it.
Of course, my pleasure.
Ari Rosa, analyst at Citi. Coming up, we're going to bring you our interview with a finfluencer, financial influencer, with more than 1 million YouTube subscribers. That's right after the break. The Plain Bagel is a YouTube channel with more than 1 million subscribers. It's a platform that aims to create educational videos for investing and personal finance. We were joined earlier by the creator, Richard Coffin, of The Plain Bagel. We started off by asking him about his day job. He has a full-time role in finance, and that helps him generate the financial content that he provides on YouTube.
It started off as an investment analyst position and still do some support on the research side. Now it's more client-facing and more of effectively a junior role where I'm supporting some of the other portfolio managers while also building a book of business. But predominantly, it's like you mentioned, it's the research and advising side of that side of business. Yeah.
So tell us about your YouTube channel. What's your meat and potatoes? What's the main content you provide?
Sure. It's changed over time. Has started with a focus on basic investment information and slowly molded into more economics. And just with the last year we've had with the U.S. trade tariffs and everything of that sort, covering more news items, but really focuses on trying to cover basic information or break things down to a level where beginners can understand sometimes more advanced topics that still impact their financial situations.
Mm-hmm. And I mean, obviously, Jim Cramer's been around for decades.
Sure.
He has his style.
Yeah.
It's kind of flamboyant.
Yeah.
And there are a lot of influencers out there who go down that road, but you're more subdued.
Well, I don't typically cover stock picks.
No.
A big part of it is really that focus on education rather than giving information and on which stocks to buy and things of that sort. A big part of that, too, is there's a lot of distrust with finance content that comes online. And I think a big part of building trust is focusing more on that high value education that helps people for their lifetime rather than picks that they might rely on in the short term. So there's a lot of reasons. You know, another part of it is the compliance side, working in the industry. It's tricky to be in the social media space and do so dotting your I's and crossing your T's properly. So it makes it a lot simpler to not go down that route. But frankly, it's just not what I enjoy doing online. I really enjoy covering the more education and broader topics.
Can you touch briefly on how you make money? You get paid by YouTube, I guess, a chunk of the advertising revenue?
Predominantly, yeah.
Okay.
Yeah, so it's predominantly YouTube AdSense is what it's called, and that's the ads that run during the videos. There's a small pie that's sponsorships, but because of the work I do in the industry, the biggest sponsorship deals are often ones I pass up because it's finance adjacent, and I don't typically cover that area. Again, from a compliance nightmare generally, but also it's about that trust. And really, I don't think I would be at this stage with the channel if I had gone down routes of promoting different aspects of the financial service industry. So it's really in terms of keeping the channel's integrity that I avoid those types of deals. So predominantly from AdSense, but when you look at other creators, there's courses and there's these sponsorship deals that are a bigger part of the pie than what I experience.
Right. And you have more than 1 million subscribers?
That's right. That's right. Yeah. One of the biggest channels in Canada.
How many of them actually watch regularly, though? Have you any handle on that?
Yeah, you do get some interesting stats behind the scenes. And interestingly, subscribers aren't a big driver of views anymore. They used to be a more important stat. These days, it's a lot more about how the algorithm treats your videos on a one-by-one basis rather than where you're coming from. And so you find that a lot of your viewership actually comes from new viewers or people who aren't subscribers. And you can have channels that aren't very big from a subscriber standpoint, but are having much more significant traffic than high subscriber count channels. So it's not as important of a statistic as it used to be. But even with that size, I've been fortunate where I've been able to get decent viewership numbers as well. And I know we can't get into it, but this is the algorithm on YouTube. That's right, yeah. People search on YouTube. That's right. So the algorithm is this ethereal entity that we all reference that we don't actually have much insight into outside of what we see from the outside. Notoriously. YouTube's very protective for IP purposes and things of that sort. But there are a lot of people who have dedicated time as creators to try and figure out what works on YouTube and the algorithm. It's also a tough thing with the finance space because sometimes what works for the algorithm isn't inherently good for viewers. So things like exaggerated titles or hyperbole and things of that sort, which can actually be detrimental to viewers, can do well on the algorithm. So it's a really tough balance to try and navigate that space without maybe doing some more harmful stuff. Isn't that interesting? So I'm just plucking an example out of the air here. If I was to put a title on my video, the AI bubble is about to explode this week. You do quite well, probably. Yeah, but it's not necessarily something that's really going to be that helpful. That's right. And, a big part of it is, and a nice thing about working while I do this is it does keep me grounded where I have to think to myself, there's a client that might be out there who watches my videos. And so if I post a video that says the AI bubble is going to collapse tomorrow or this stock is going to surge 1,000% tonight, I have to answer to that person at the end of the day when they give me a phone call and ask, hey, what was that thing you were talking about online today? So it does help in that regard, and it's been a good grounding force through all this. You're about to turn 33. That's right. So tell us about the age group and the gender breakdown of your viewership. Sure. On the gender side, it's predominantly male, which tends to be what we see in the industry. About 90% male viewership for the YouTube channel. That's right. Interesting. Yeah. And in terms of age demographics, tends to be that 20 to late 30s age group. So a lot of it is mirroring the demographics of the person you're watching. That does play a small role, I'm sure. Late 20s to 30s. Mid 20s to late 30s tends to be the age group. And so it is that younger, at times Gen Z investor group that tends to use social media more often. And we've seen that it's growing. We've had a lot of research to support that younger generations are predominantly using social media to inform their investment decisions these days compared to prior generations. And you find that YouTube is the venue for you? Are you on TikTok or Instagram? I've looked at other platforms. For me, I very much treat this as a hobby, or I try to treat it as a hobby, despite how big it's gotten. And so I'm not very strategic with the platforms I go on. I've heard that TikTok is an amazing discovery platform and then a great way to then transfer viewership from there to more monetizing friendly platforms. But, it's a tough, TikTok's a big one for finance, but it's difficult with the short form content with the type of topics I try to discuss. So I find that YouTube I like to focus on just the one platform. It tends to be the biggest platform for people looking for financial information, interestingly enough. So it's a good kind of mix where I can focus on this one core platform, which also tends to be the highest monetizing platform from an AdSense standpoint. Richard Coffin, YouTuber at the Plain Bagel. He actually works for WDS Investment Management. It's an Ottawa firm with about $400 million in assets. Thank you very much indeed for watching our show. Do we have time to have a quick look at the TSX in record territory? It looks as though we are going to get a new record high close if the market can hang on to this momentum. The first close in history above 33,000. So despite all the threats to the economy, well, mostly the trade war, investors buying into those Canadian stocks. So far, our index this year, as of today, up 4.2% in calendar 2026. The S&P 500 and the Nasdaq are up just under 2%. And let's have another look at gold. I'm just going to check out the spot price for the precious metal. Gold setting record after record, down a little bit. The February futures, sure enough, we've got the spot price around 4,614, down a little bit from yesterday's record. Thanks for watching The Open. Morning Markets is coming your way.